Ja, ich darf erstmal herzlich Daniel Blum begrüßen von Jupiter, der hier live mit mir auf der Bühne steht. Und gleichzeitig möchte ich eigentlich, wenn ich ihn jetzt sehen würde, können wir den Herrn Bezalel in London live begrüßen. Jetzt, es hat geklappt. Ein herzliches Grüß Gott nach London. Nice to see you.
Lovely to see you too. Thank you for having me. A real pleasure.
Gut, Herr Bezalel ist Investment Manager im Fixed Income Team von Jupiter und blickt dabei auf 25 Jahre Erfahrung zurück. Und Daniel, du bist auch schon sehr, sehr lange bei Jupiter, nämlich seit 2005. Und mittlerweile verantwortest du als Wholesale-Leiter den Vertrieb in Deutschland. Wir starten jetzt mit Herrn Bezalel in London. Und später dann, wenn es zu dem Fragenteil kommt, wird Daniel wieder mit auf die Bühne kommen und die Fragen mit mir gemeinsam moderieren. Und in der Zwischenzeit wird er allerdings aus der zweiten Reihe heraus die Präsentation für Herrn Bezalel in London steuern. Okay, so, the floor is yours. Please.
Ariel, give me one brief moment.
Okay, sorry.
Herzlichen Dank, Michael Schmidt. Ich darf Sie auch nochmal ganz, ganz herzlich begrüßen. Wir sind ja seit vielen Jahren bei den TIAM-Veranstaltungen dabei. Das heißt, Sie kennen uns oder sicherlich die meisten. Und wenn Sie uns kennen, kennen Sie uns in der Regel für unsere globale Anleihenstrategie, die eben von Ariel Bezalel und seinem Team verwaltet und verantwortet wird. 2022 war ein historisch schwieriges Jahr an den Anleihenmärkten. Wir hatten diesen wirklich historischen Crash im ersten Halbjahr. Wir haben anhaltend hohe Volatilität im Anleihensegment und deshalb freue ich mich ganz besonders, dass wir Ihnen hier und heute ein Update und einen Ausblick zu unseren Erwartungen für die Anleihen im nächsten Jahr auch geben können. Und dafür übergebe ich jetzt sehr, sehr gerne an meinen langjährigen Kollegen und geschätzten Fondsmanager Ariel Bezalel. Ariel, over to you and let me know when to press the button, please.
That's great. Good afternoon, everyone. And as I said before, a real pleasure to be here. My name is Ariel Bezalel. I'm the fund manager for the Dynamic Bond Fund. It's a strategy we've now been running for a bit over a decade for Dynamic Bond. And it was really on the back of the success of the UK version, which we launched in 2008. So if we jump to slide 4 of the presentation, please, Daniel. And here you can see the strategy today is more or less around about 11 billion euros. Helping me run the strategy, I've got a dozen or so analysts. And there's another fund manager who helps me run the strategy, Harry Richards. Some of you may have come across him over the years. But effectively, the Dynamic Bond Fund, as you can see on the next slide, is really very much a top-down, bottom-up fixed income strategy, so very much a flexible, unconstrained strategy that takes macro views, so very much a heavy top-down influence in terms of how we allocate assets, and that involves taking rates bets around the world. But also, we pride ourselves a lot on our credit picks in the portfolio. And that's where the analysts kick in and help me cherry pick globally the best opportunities across corporate debt, as well as interesting sovereign opportunities around the world. So we know no boundaries when it comes to geography. We're very active across Europe and American credit. And then also we do delve from time to time across the emerging market landscape as well. And we know no boundaries across the rating spectrum. So we're very active, as I mentioned, in high quality rates. And then we also delve into high yield and sometimes even look at the world of distressed from time to time as well. Now, if we move over to the next slide, and the next one, we can talk a bit about performance on the next one, and the next one, there we go. So, and the next one, please, Daniel. On this slide here, you can see the long-term performance of the fund is very strong since we launched in 2012. You can see here we've vastly outperformed the peer group. And there have been very, very few occasions over the last decade where we've, on an annual basis, underperformed the peer group. This year has definitely been a much more challenging year for us. And I can summarize as to the reasons for that underperformance versus the peer group. And in essence, coming into this year, our view was that around about Q2, Q3, we would start to see signs that inflation was peaking, and rates would eventually roll back down again. However, what caught us out was the Russian-Ukraine war. That gave another shot into the arm for the inflation trade, and led to government bond yields lurching a bit higher, which was a bit costly to the strategy. However, that for us just simply meant that the days when inflation would peak was going to be pushed out another 1 to 2 quarters. And subsequently, we are beginning to see now inflation, a lot of signs around the world that inflation is starting to peak. And in the last few weeks, we've seen a material rally in rates and in corporate debt as well. And so in the last couple of months, we've enjoyed a strong bounce from the lows in terms of fund performance, as I said, in the last couple of months. Now, what I would like to do from here really is really talk about our outlook, how we see the macro picture evolving over the next 12 months, and then also talk about asset allocation, where we see the opportunities within fixed income. What I would say is, something we've been telling clients already for the last 1 to 2 months is that we haven't been this excited about the opportunities within fixed income across government bonds and within corporate debt for quite some time. And then we'll talk about how the fund is positioned today, and then at the end we can hopefully take on some questions. So if we go to our outlook slide, please, Daniel. There we go. Right. So, we've labelled here second half of 22 to be crunch time. And our view is that we are seeing a pervasive weakness around the global economy. Our concern right now is that central banks, very much led by the Federal Reserve, are now heading to overkill territory when it comes to hiking rates. Now, the reason why we say that is because, well, firstly, you've got to bear in mind that it takes about 12 to 24 months for rate hikes to filter through to the real economy. So we don't really know the true damage that's being done by the rate hikes that have been fired at the global economy thus far. But what you need to bear in mind is that over the last, coming up to nearly 2 years now, we've seen something like approaching 400 rate hikes globally. On top of that, we've now got a Federal Reserve which is doing quantitative tightening since September of about 95 billion a month. Then we've had a sharp rise in government bond yields and corporate bond yields. And then we've also had this a decent rise in commodity prices, which we believe also acts as a bit of a drag on economic growth. So there's been, historically speaking, an unprecedented amount of tightening in such a short space of time. And all this tightening, we believe, inevitably is going to slow down the global economy. So it's literally the complete reverse of the enormous amounts of stimulus we had during COVID and post-COVID. That is now being completely reversed. And inevitably, we believe that's going to, as I said, act as a brake on economic growth, and in turn, bring down inflation quite rapidly over the next 12 months. So to summarize, we see a pretty decent cyclical slowdown unfolding, and that's why we are very constructive about government bond yields, and why we are constructive on parts of credit markets where we see a recession now being priced into investment grade, and some sort of decent slowdown also being priced into parts of the high yield market. But what I must emphasize, as we go into 2023 and this recession plays out, credit selection is critical because undoubtedly the more cyclically exposed companies will be challenged in this economic environment. Now, if we move over to the next slide, what I want to share with you is, a lot of the signs that we are seeing of a slowdown unfolding and why we believe inflation is set to come down. Now, firstly, what you can see here is during the COVID crisis, we had about $9.5 trillion of easing in just the US economy across fiscal and monetary policy. And subsequently, as we can see here, over the course of 2020 and 2021, we had this incredible surge in money supply growth. Since then, with central banks and governments, for that matter, taking away the punch bowl, we've seen a collapse in money supply growth to the extent that, as we sit here today, year-on-year money supply growth is now running at close to zero in America. In the last 3 months annualized, we're running at around about minus 4.5%. The last time we saw those kind of numbers, in such deeply negative territory was actually at the back end of the Great Depression, back in the late 30s. So this is a big factor. If you believe that inflation is each and everywhere a monetary phenomenon, as to why we believe the inflation picture is going to improve quite markedly over the next 12 months. If we move over to the next slide, and the next one, what you can see here is that we've seen this incredible contraction in central bank balance sheets, very much led by the Federal Reserve, who are now doing $95 billion a month of QT. As they hike rates, look for money supply growth to continue to contract. And also, what you can see on this chart is this pretty compelling correlation that as central bank balance sheets continue to contract, that should also help to bring the inflation numbers down over the coming 12 months as well. Now, moving on to the next slide, what you can see here is, something we're seeing in recent months in America is that credit growth is now starting to tighten up. According to the latest Federal Reserve Senior Loan Officer Survey, bank lending is now starting to cease, and this is something we're now beginning to see in Europe as well, in fact. Moving on to the next slide, and the next one, please, Daniel. You can see here also that as well as monetary policy acting as a headwind, as a drag on economic growth, as central banks around the world, as I mentioned earlier, are tightening policy aggressively, fiscal policy, you can also see here, is also acting as a drag on economic growth. What I would also add is in America today, we've got a pretty divided Congress. And so it's very unlikely we're going to see any kind of material fiscal loosening in America. What we had with the accident recently in the UK gilt market, as Liz Truss, the former Prime Minister, tried to aggressively loosen fiscal policy, the bond vigilantes didn't like it, and that tells me that it's very unlikely we're going to see any significant easing from any other governments because they know what's waiting in store for them if they dare try that. Moving on to the next slide, what we can see with regards to economic activity is manufacturing activity in particular is slowing down very, very sharply to the extent whereby if we look at the new orders component of the PMIs, they have collapsed in recent months to the extent that 75% of countries, their new orders component is now in contraction territory. PMI manufacturing globally is now gone sub 50. So we're now in contraction territory, and that is now beginning to filter through into the services sector, where also we're beginning to see activity slow down. And that's typically what happens in previous economic cycles. It's usually the manufacturing sector that goes first, and then inevitably services follow suit. Moving on to the next slide. You can see here South Korea, countries like South Korea, the likes of Sweden as well, interestingly, are good economic bellwethers. South Korea is one of the leading manufacturers of things like semiconductor chips. And the likes of Sweden has a very open economy, which is also very much focused on manufactured goods. And their PMIs also have been, collapsing into contraction territory. So these are good leading indicators telling us that the global economy is pretty weak. And obviously, we've seen the likes of oil prices lurch lower recently, together with other commodities, again telling you that global demand is faltering. Moving on to the next slide. This merely shows you that if you look at the leading economies around the world, you can see the global composite PMIs are now falling into contraction territory. So that's looking at manufacturing and services combined for some of the leading economies around the world. Now, moving on to the next slide, what we can see here is that chief executive confidence in America has really plummeted, as many chief execs, the majority out in the US today, are looking for a recession to unfold in 2023. And then moving on to the next slide, something we're seeing amongst many corporates in America is a big build in inventories, a big inventory overhang. And so what we're seeing in the inflation numbers of late is that goods inflation is now stagnating. It's running around about zero. We think with all this inventory and the likelihood that we're going to see a slashing of prices to shift that inventory, we are now tipping into goods deflation. So at the moment in the inflation numbers, it's really dominated by still decent services sector inflation. And that's really brought about by primarily by rental inflation in the housing market. But a lot of the live data that we're seeing as we speak is telling us that rental inflation is now starting to roll over. And so inevitably, with a lag of 3 to 4 months or so, that should filter through into the US CPI numbers and lead to somewhat lower US inflation numbers from about Q2, Q3 onwards of 2023. Moving on to the next slide, and the next one, please, Daniel. The other interesting dynamic we're seeing, which again tells us that the outlook is weak, is the consumer. The consumer is in a very difficult spot right now because real wages are simply not keeping up with the price hikes we're seeing in the stores. So real wages are somewhat negative, running at around about 3.5% to 4% in America. In the likes of Germany now, we're running a real wage growth of around about -6%, which is quite similar to what we're seeing in the likes of the UK and Spain as well. And that goes a long way to explain why consumer confidence has taken a bit of a dive year to date. And moving on to the next slide, we can see here that households are under, their finances are now under material pressure. So we've seen savings rates have crashed to the most recent numbers, which we had yesterday, in fact, have now shown the savings rate in America has now gone sub 3%. That is actually the lowest since 2005. And in order to maintain their spending habits, we're seeing quite a ramp up in credit card borrowing. Moving on to the next slide, you can see here that consumer confidence has taken a dive with, as I mentioned, the negative real wage growth, the high cost of living, etc., really damaging sentiment. And then on the next slide, something we're seeing, and this is not just in America, is some sort of housing crisis globally beginning to develop, very much led obviously by China. So in China, we've had quite an implosion in the housing market, which is really the key driver as to why the economy in the last year or two, together obviously with zero COVID measures, the economy in China is basically stagnating as we speak. But with the sharp rise in rates we've had over the last year and a half or so, we're seeing double-digit declines in housing in places like Australia, New Zealand, Canada. The housing market there is a bit of a bloodbath. In the UK this morning, we've had, in fact, some more data showing further weakening in UK house prices. And in America, although mortgage rates are tied more to the longer end of the curve, and it's not like places like Australia, the UK, where mortgage rates are determined by the base rate or short-term interest rates. We are still seeing mortgage rates moving up through, well, we did see them going up through 7% not long ago in America. They have eased back a bit, but they're still at very elevated levels, and subsequently we've seen volumes collapse. We've seen mortgage applications have dropped by over 80% year on year. And so inevitably we're seeing house prices coming under pressure in America, together obviously with rents as well. Now, what I would also add is that we need to bear in mind that property stroke housing is the biggest asset class in the world at around about $250 trillion, which is almost 3 times the size of equities at $90 trillion. And so typically, historically, where housing goes, the economy goes. Now, moving on to the next slide, you can see here that housing affordability in America has basically gone through the lows that we saw during the GFC in 07-08 with the surge in mortgage rates. And moving on to the next slide, the other dynamic which is likely to pressure house prices is there is a big pipeline of supply of new builds to come through over the coming months and pressure the housing market even further. Moving on to the next slide. And if we can move over to the next one, please. And so this, just quickly here, you can see a number of states across America beginning to register double-digit declines as housing volume collapses. Moving on to the next slide. And as I mentioned, this is very much a global phenomenon where a lot of markets are now registering double-digit declines year on year. In fact, in Australia, the decline in house prices is even more rapid than what we saw in America during the GFC. Moving on to the next slide. And if we can move over to the next one, please. And so what we are seeing is that house builder sentiment has collapsed in America, as represented by the dark blue line here. Now, what I would also add is directly or indirectly, the housing sector is responsible for around about 12 million jobs in America. So inevitably, as house builder sentiment deteriorates, and we've got it pictured inversely to the right axis here on this slide, as housing sentiment deteriorates with a lag, inevitably we start to see the unemployment rate start to move higher. So it's no surprise to us lately that we are beginning to see some cracks appearing in the jobs market. And we expect that the unemployment rate will start to move higher over the course of 2023. And that tightness in the labour market, concerns about wage pressures, should ease pretty dramatically over the course of 2023 and allow the central banks to ease off on the tightening of policy. Moving on to the next slide. This is a real eye-opening chart and really highlights the extent of the bubble we have in Australia, whereby the value of residential land to GDP down under has now exceeded what we had in Japan in the late 80s. That was a renowned property bubble, where in fact the land on which the Emperor's Palace sits at one point was reckoned to be worth more than the whole of the state of California. So, subsequently, we all know about how Japan entered a deflationary bust over the 90s and hasn't really recovered since. And we do fear that there is a a severe housing bubble in Australia, which could come under even more severe pressure as the RBA hikes rates even further. It's worth bearing in mind in the likes of New Zealand and Australia and in the UK, in fact, between now and the end of next year, you've got a vast pool of mortgages that are going to be set at, or reset rather, at significantly higher rates as their fixed rate deal expires effectively. Moving on to the next slide. Moving on to the next one, please. And this shows you what I highlighted earlier, that rents in America now look like they are peaking, and that should feed through to somewhat lower inflation data. As an aside, I'm sure a lot of you know that the rental component in the inflation data in America accounts for as much as 30 to 40% of the CPI, depending on which inflation measure you're monitoring. Moving on to the next slide. Going back to China, this slide really highlights the monumental bubble we had in China. Housing got to as much as 30% of GDP in China. It went to as much as nearly 80% of household savings in China. And now that this bubble has burst, we are concerned of some sort of Japanification now unfolding in Now, China has a lot of the same ingredients as Japan did in the late 80s. They are now going through a demographic cliff. The workforce has been contracting over the last decade or so. They've got an aging population. The overall population is set to fall by nearly half by 2100. Some people even say it's going to go to about 500 million by 2100. All this is really a big side effect of that one-child policy. So all this tells us that there has been a permanent structural change lower in terms of economic growth in China going forward. So that has obviously big implications for global growth. Over the last 10 years or so, China has been as much as about a third of global growth. And if I'm telling you that going forward, growth is unlikely to be 5 or 6%, but more like about 2% at best in China, then that also paints a kind of more clouded picture for the demand for things like commodities as well. Now, moving on to the next slide, and if we can move on to the next one as well, again, and the next one, please, Daniel. We can see here commodity prices have come off pretty sharply in recent months. A lot of that undoubtedly driven by global weakness, but also because of the weakness in economic activity in the likes of China. And then moving on to the next slide, you can see here that China accounts for as much as half the demand for the likes of copper, aluminium, and other base metals, and as much as nearly 20% of global demand for oil also comes from China. And hence why I'm saying that the commodity picture, the commodity outlook, despite the big underinvestment in things we've seen like energy and copper and what have you, if China is no longer demanding a lot of this stuff, then the outlook is a bit clouded. Moving on to the next slide, other kind of drivers of why we think the inflation picture is set to improve. We've seen the likes of electricity prices come off. Gas prices have been coming off quite sharply in the likes of the US and Europe. We've also seen things like trucking rates, container rates. All these things are now back to levels we saw pre-COVID, and supply chains are now gradually being restored as well, as I'll demonstrate graphically shortly. If we move over to the next slide, and you can see here food prices, they've also been rolling over lately, and again should filter through to lower inflation numbers in coming months. And on the next slide, and the next one, please. This shows you, as I mentioned earlier, that freight rates shipping rates from the likes of Asia to America. They've all gone back to levels we saw pre-COVID. So we're not really hearing those stories anymore about queues of ships at the ports of LA. And in fact, I believe for the month of October, so a couple of months ago, was the quietest month at the ports of America since 2008, in fact. So as I mentioned, retailers have got too much product and the consumer demand for durable goods has collapsed. Moving on to the next slide. This shows you work done by the Federal Reserve of New York, and that ties in with evidence we've seen from the likes of Citigroup and UBS, saying that supply chain issues have now disappeared. Moving on to the next slide, and that obviously helps the inflation picture as bottlenecks are removed. And the other big driver of inflation earlier this year was used car prices and new car prices, and they've also come off pretty sharply over the course of this year. And in fact, year on year, used car prices are now down between 10 and 15%. Moving on to the next slide. If we move over to the next one, please, Daniel. What I'd like to do now is just talk about inflation and why there's nothing better than a good old-fashioned recession to bring inflation down. And what we've done, we've looked at over 100 years of data. And with each recession, on average, inflation comes down by as much as nearly 7%. And it takes, on average, around about 16 months for inflation to hit the central bank's target of about 2%. Now, admittedly, this time around, inflation could be that bit more persistent because of the enormous amounts of fiscal and monetary policy that's been injected into the global economy. But nevertheless, with a rapid decline in money supply growth, with the massive increases in rates around the world, we think recession is now the base case. And the debate really is now about the magnitude of the recession. And our concern is that from here in, if central banks continue to hike rates, then a hard landing becomes more and more likely. If we look at the shape of yield curves around the world, in America in particular, the yield curve is the most inverted since the very early 80s. The 3-month 10-year, that has the best predictive powers, 8 out of 8 in terms of predicting a recession. On average, once that curve is inverted, it remains inverted for at least 10 days, then on average, about 300 days later, a recession unfolds. So that tells us a recession is very likely by around about second half, early second half of 2023 in America. And that's why we've been increasing the duration and our exposure to government bonds over the course of this year, but admittedly it has been a bit like catching the falling knife. Moving on to the next slide. This shows you that even in the most inflationary periods during the 70s, a recession is very, very good at bringing inflation down. And the next slide shows you that as inflation comes down, as the recession unfolds, typically that triggers a phenomenal rally in government bond yields. Now, moving on to the next slide, just quickly here, you can see that spreads on investment grade bonds or triple Bs and spreads in double Bs, which is what we prefer at the moment in credit, are pricing in some sort of recession, unlike equities. So in our opinion, fixed income is becoming a much more attractive asset class. And with the yields you're getting nowadays and the kind of recession that's being priced in, it makes it a much more attractive proposition than the likes of equities, where nothing like a recession is being priced in, especially in the US equity market. Moving on to the next slide. Let me jump to asset allocation in the interest of time. The fund today, as we sit here today, we are delivering to investors a yield of over 6% for an investment grade portfolio. So on average, the fund has a credit rating of BBB, and the duration of the fund is a bit over 7 years, which is definitely non-consensus. We're definitely at the longer end in terms of duration. A lot of that duration is driven by our exposure to the likes of US Treasuries, Australian government bonds, New Zealand and South Korea. All those countries really suffering from housing downturns, consumer debt bubbles, and what we see a sharp slowdown in prospect over 2023. Moving on to the next slide, you can see here in terms of asset allocation. Today, yes, we do have high exposure to high yield at half the portfolio, but what I would add is that that's dominated by defensive sectors, healthcare, telecommunications, the gambling sector, which tends to be fairly recession resilient. And today we have nearly 40% of the portfolio in high quality government bonds. So effectively you have a kind of barbell strategy in place. Government bond yields at these kind of high levels should now provide decent protection to the corporate credit book, as we're likely to have quite a volatile economic environment over the course of 2023. So let me finish it there, and I would love to take some questions for the audience, assuming we have time.
Jetzt war er doch etwas schneller, als wir beide dachten. Gibt es schon mal Fragen aus Chat? Gut, gibt es hier Fragen? Nicht. Einen Joker müssen Sie mir liefern. Gut, dann gebe ich jetzt mal an dich ab, Daniel.
All right, I'll pull out one slide, and Ariel, I'd love for you to very briefly comment on, hang on, I got to watch here, on this one, because that is a very important slide. That one, I think that is really a great one to finish on, and then I'll do a very brief 90-second summary. But Ariel.
Yeah, of course. I mean, what it shows here is that, due to fantastic credit selection over the last decade or so by my team, we've done really well to avoid blow-ups or defaults in the portfolio. So even during the COVID crisis, you can see here where default rates surged over the course of 2020. The fund still experienced default rates of less than 1%. So, as I mentioned right at the beginning of the presentation, credit selection is critical, and we believe that the credits we have in the portfolio, in the main, are recession-resilient credits, where the top line and the bottom line should be pretty resilient. So, it's dominated by healthcare, pharmaceuticals, cable, telecom. And over half the portfolio within our high yield bucket is senior secured paper, where we're secured on assets such as telecom networks, cable networks, and in some instances property as well. So that protects you to the downside and ensures very high recovery rates in the event that there was to be a default.
Thank you. Jetzt hätten wir doch noch 2 Fragen. Dürfen wir die noch?
Natürlich.
2,22.
Stopp. Bitte, dann können wir nicht.
Bis Jahr 2022 fehlt.
Das läuft noch. Das ist immer für vollständige Kalenderjahre.
Ja, ich meine, ich kann ja Jahre zuvor gut gearbeitet haben und vielleicht bin ich höhere Risiken eingegangen, habe dann natürlich eine Outperformance dadurch geliefert und wird dann im Jahr 2022 eingeholt. Das würde mich jetzt interessieren.
Ariel, very quickly a question. Any defaults in 2022? So what's this figure going to look like for the current year, please?
Yeah, this year to date we've had, in terms of default rates, again, comfortably less than 1%, I'm pleased to say. Negligible amounts.
Thank you. Und Herr Graf?
Mine is very short. Are these slides available for the audience, or is there a chance to get them somewhere else? Because some of them are highly interesting and I would be glad to get them.
I'd be delighted to send them to you. Ich schicke Ihnen die sehr, sehr gern im Nachgang zu. Auch gilt es natürlich für alle anderen. Das heißt, Sie kommen auf die Seite. Wenn Sie sie nicht finden, schreiben Sie mir eine E-Mail. Ich darf dann ganz kurz zusammenfassen. Wir gehen davon aus, dass die Inflation den Höhepunkt erreicht oder überschritten hat. Die Geldpolitik hat den Hebel umgelegt. Dem Markt wird in Rekordtempo Liquidität entzogen, an die wir uns in den letzten Krisen, auch während Corona, gewöhnt hatten. Das heißt, wir sehen eine starke wirtschaftliche Abkühlung bis hin zur Rezession. Wird die Notenbanken zwingen, früher oder später den Kurs zu ändern. Davon profitieren wir dann über die lange Duration und die hohe Qualität im Portfolio. Deshalb unterm Strich glauben wir, die Assetklasse ist so attraktiv wie seit der globalen Finanzkrise nicht mehr, und dies ist jetzt schon wieder einige Jahre her. Deshalb denken wir, guter Zeitpunkt, sich aktuell wieder mit Anleihen zu beschäftigen. Ganz, ganz wichtig, und deswegen hatte ich nochmal Wert gelegt auf diese letzte Folie. Wir sehen eine Rezession spätestens für nächstes Jahr in den großen Wirtschaftsräumen, und deswegen wird Selektivität, die Einzeltitelauswahl, die aktive Einzeltitelauswahl, das aktive Management auch wieder ganz entscheidend sein, um eben die Ausfallraten niedrig zu halten. Und das hat eben das Team von Ariel Bezalel eben in den letzten Jahren seit Auflage, wie man hier sehen kann, wirklich ganz hervorragend hinbekommen. Damit bedanke ich mich sehr, sehr herzlich. Thank you, Ariel, for taking the time this morning and being with us. Und bei Ihnen bedanke ich mich ganz, ganz herzlich für Ihre Zeit, Ihr Interesse, und freue mich, ich bin bis heute Abend da, auf weitere Fragen und Gespräche. Dankeschön.
Vielen Dank für die Zeit.